Hello there. Welcome to Financial Accounting and 6. Today we want to look at the question paper of November 2022. This was question 3 on that question paper, and it requires us to prepare the income statement. So we are going to go through the information that we have in the question and answer what is required. So at the beginning of the question there, it reads, the information below was extracted from the books of Funnies Limited for the year ended 29 February 2022. The business is a cost price markup of 70%. So very important to take note of the markup price in terms of our calculations that we are going to make there. Then we are given a pre-adjustment trial balance on 29 February 2022. Right. So what it means is our year is ending on 29 February 2022. So we can just take note of the period of our financial period. Remember, our financial period is supposed to be 1 year, and it's ending on 29 February 2022. So it means starting the previous year the following day of February, which is of 29 February, which is 1 March 2021. 2021. So it means starting a year and it's ending on this date. So that is our financial period of 1 year. So every calculation that we are going to make that needs us to maybe to apportion in terms of the periods, we're just going to refer to that period. So we are given those the information that we have there, and we go down the information of the balance that we are given in that pre-adjustment trial balance. Beneath that, we have got information that we are given below that reading adjustments and additional information. On the first part, we have got credit sales of 15,300 on 29 February 2022. They have not been recorded in the books. So these are the adjustments that we are going to refer to as we go through the income statement. Then we also have stock on hand, which means this is on 29 February 2022. So this one is representing the closing inventory that we have at the end of the period. We have got trading inventory of 49,590, and we have got stationery there. The stationery figure is 2,546. So if you go to the next page to see what we have there, we also have additional information that is going down. So it's very important to go through this additional information before you start to answer the questions, as it is going to help you to remember wherever there is an adjustment which needs to be done. But in this case, we are just going to go through and refer to any adjustment that might be required. Then we go again to the next page. Our item 14, we've got property, plant, and equipment. And we are told that a vehicle was sold at its carrying value on the last day of the financial year. Depreciation is written off on vehicles at 20% per annum on the diminishing balance method. This is the reducing balance method. And the land and buildings were sold at cost during the financial year. So this is what we have. We have got a column for land and buildings, vehicles, and equipment, meaning these are the non-current assets that we have there. And we go beneath that. Let's just quickly to move to the section that we want to answer according to this video. So according to this video, we are just going to answer the section of calculating, starting from here. Calculate the missing amounts indicated in note 14. These are notes that we are given there of non-current assets. Then I will also prepare the statements of comprehensive income, or the income statement. So so these are the two that we want to prepare according to this video, right? So we are going to start with the calculation of the missing amounts indicated in note 14. So if you go to note 14, there, note 14 is just above there. This is the note 14 that we have here. This is the 14 that we are being referred to. So 14, and it's on property, plant, and equipment. And remember, the depreciation is 20% per annum. And also the method we are using, the diminishing balance method. This is on vehicles. That's what we have there. And then if you look at A, so what it means is the figures that we want to calculate there is A. They are indicated as A, B, C, and D. So let's start with A. A, we have a disposal at carrying value. Disposal at carrying value. And it's A. And we are seeing that on landed buildings, we do not have any accumulated depreciation. Remember, these landed buildings they don't depreciate, and also there are no additions that are there. We only have disposals. Additions are indicated zeros, meaning there are no additions, but we have some disposals that are there. So we need to find this figure of disposal. But this is very easy to find because we do not have any additions, one, plus we do not have depreciation in terms of this non-current asset. So basically, here you are seeing that the value that we have at the beginning is reduced to from 3 million to 2.5 million. So what we are going to do is just to calculate the difference between the two, and it's going to indicate that the figure for disposal. So it means we started with 3 million, and then we disposed part of the landed buildings, and we are left now with 2,500,000. So the difference between the two will indicate to us the disposal that we have. And remember, if you come here, I think we have got an instruction that is also leading us there. Here, it's reading land and buildings were sold at costs. So it means the disposal was on costs, which means the cost is inside this one, the figure that we have, the 3 million. So we just so the difference between the costs at the beginning and the cost at the end will represent the disposal. So we go there and try to just summarize the working that we have there. This is part A. Part A, we are just going to say 3 million. Then we subtract 2,500,000. And then obviously, if you do that, we are going to get 500,000. So that's our part A. Then we go to B. Let's try to see B now. B is here. B is there. And if you check that one, it's representing depreciation for the year for vehicles. Depreciation for the year for vehicles. But we want to see what really happened in terms of these vehicles. I think we put an instruction in terms of those vehicles. Right. If you read here, it's reading a vehicle was sold at its carrying value on the last day of the financial year. Depreciation is written off on vehicles at 20% per annum on diminishing balance. So the key area that we have there is that depreciation. The vehicle was sold at its carrying value on the last day. I think that's where we have the key part here. On the last day, it means this vehicle, which was disposed on the last day of the year, which means it stayed 12 months in that financial period, or in other words, it stayed the whole year. So this depreciation rate of 20% per annum is going to apply also to that non-current asset. So we are not going to apportion in terms of the months that vehicle stayed, because it stayed 12 months, just like the other old vehicles that were there. So we are just going to use the formula that we know for calculating depreciation using the diminishing balance method. Remember, the diminishing balance method, we say a percentage, and then we multiply by the carrying value. Whereby the carrying value, we would have found the carrying value by saying costs minus accumulated depreciation. So we can start by trying to find what we have in terms of the carrying value. So we are on vehicles. At the beginning, the carrying value we are given is here. This is our carrying value, 660,000. So it's already calculated, no need to calculate it. So we are just going to say the percentage. Remember, the percentage is given here is 20%. So we are just going to say 20% of the carrying value, which is 660,000. So here now we are saying 20%. Remember, 20% is a decimal. We can just represent it as 0.2 as a decimal, or 0.20. Then we multiply by 660 as our carrying value there. So that's what we have in terms of that depreciation. We calculate that one. We are going to get 132,000. So 132,000 becomes our depreciation for motor vehicles for the period. So it's going to come here as our depreciation. Then after that, we also have the figure that we need to find there, which is the C. And if you go to C, let's check the details in terms of what the C is representing there in the table. We have got disposal at carrying value. So this C is disposal at carrying value. And remember, we have got now our depreciation for the year. We have got the carrying value at the beginning. we also have the carrying value at the end. So that makes it easy now to find it. Remember, we're just going to use that that method of the T account using the carrying value amount. Remember, we prepare the T account using carrying values. So we are now on C. We can just maybe start by presenting this as a non-current assets account. It's like this, and then we know that the carrying value at the beginning, the carrying value balance at the beginning comes on the debit side, and the carrying value balance at the end comes on the credit side, and then the depreciation for the year comes on the this is depreciation for the year. This is the figure that we calculated, 132,000, and then also we have the disposal at carrying value comes with the credit side. At carrying value comes with the credit side, and then any purchase will come on the debit. Obviously, this purchase will be in the form of cost, of the cost price. So that's what we have there. So we just take the figures that we have there, and remember, in terms of vehicles there in the question, we do not have any purchase that is there. But the figure that we are trying to find here is disposal at carrying value. So this is the figure that we want to find, disposal at carrying value. So we just substitute the figures that we have there in the question in the table. We go to the table first and see the figures that we have there. Remember, we have got we are on vehicles. This is the figure that we want, and then this is the carrying value at the beginning, which is going to the debit side. This is the carrying value at the end, going to the credit side. This is the depreciation for the year going to the credit side, and then C becomes the balancing figure. We do not have any additions. Additions are the purchase. We do not have anything. It's zero. So we just substitute those figures that we are saying there, 660,000. Then we come here now. Now we are saying we open the T account now and put the figures that we have there. Remember, carrying value at the beginning, we have got 660. We are putting it on the debit side, and then we've got carrying value. Carrying value at the end is 446,000 comes on the credit side, and also we have got depreciation for the year, which is the figure that we have just calculated there, which is 132,000 is coming also on the credit side, which is this one. Comes on the credit side. So the figure that we want to find is here for disposal. So what we are going to do there, we just make find X as a balancing figure there. So we are just going to say 660,000 minus this one, then we get our X. So we can just maybe summarize the working as saying 660,000, and then we subtract 446,000, and then also subtract 132,000. So if we do that, so you see that the figure that we are going to get there, we are going to get 82,000. So 82,000 becomes our disposal at carrying value. So that's what we have there. So we move on to see the next unknown that we are looking for there. We now have D, but D now is on the last part, which is the equipment. D is here, and we see that D is representing carrying value at the end. Carrying value at the end. Here, D is carrying value at the end. And remember, carrying value, we say cost minus accumulated depreciation to get the carrying value. Then the accumulated depreciation, sorry, is not given there. It's a question mark. So what it means, we need to find the accumulated depreciation there. So to find the accumulated depreciation, remember, also we can say the depreciation, accumulated depreciation that we have at the beginning, we add the depreciation for the period to get the accumulated depreciation at the end. Basically, what we are saying here, we are saying this figure is the accumulated depreciation at the beginning. We add the depreciation for the year, then we get the closing balance of accumulated depreciation that we are going to put here. So if we say 52,500 plus 55,500 there, let's try to calculate that one to see what we get there. We are saying 52,500. We add 55,500. 55,500. then we are going to get 108,000. Get 108,000. So it means here we've got 108,000. So what does it mean now? We are now saying this one, we are now subtracting 258,000 minus 108,000. So basically, maybe you can summarize that one just beneath that. Here we are now saying 258,000, then we subtract 108,000. Then you get your net book value, which is T there. So if you calculate that one, you're supposed to get 150,000. So this one becomes our T. So D here to represent our D. So that's what we have in terms of the that note 14. So we go to the next question that we want to look at now. The next question, remember, we are now on 3.4. We want to look at the on the preparation of the statement of comprehensive income for Fanny CC the year ended 29 February 2022. Statement of comprehensive income is the income statement, remember, and the figure that we are going to start with is the figure for sales. We go to our balances to check the figure for sales that we have there. We go there, we go back to see what we have in terms of balances. This is the section of the balances that we have. We start with sales or revenue. So the figure for sales is this one, which is revenue. It's also sales. So it's 967,000. This is the figure that we start with in the statement of comprehensive income. So we check whether there are any returns in terms of these sales. If there are any returns, we need to subtract these returns to get the net sales figure that we are going to put in the income statement. So what we have there is we have got 967,000 as our revenue. Then we check for any returns. Returns are here. These are returns. Debtors allowance represents the returns that we have in the form of sales returns or returns inwards. So we are going to subtract 23,000. And then we also check in the additional information if you have got anything that is reducing the sales figure or the revenue figure. So we can go item by item trying to check what we have that is affecting these sales. You see at the first item, we've got something that is affecting sales there. Credit sales of 15,300 on 29 February 2022 have not been recorded in the books. These are sales which have not been recorded, but also we should check note that these are credit sales. These are credit sales, and remember, when they are credit sales, they are also going to increase the value of our debtors control or our trade receivable control, because these are our customers that are buying on credit and they are going to be our debtors. So we can take note of that as we go. Remember, we are going to calculate the provision for doubtful debts. So this figure, it has also to be adjusted there. So we have some sales there, so which means our sales figure or revenue figure is going to increase by 15,300. That's what it means there. So the adjustment that we have is that it is reducing by that debtors allowance of 23,000 and then increase by these credit sales that were omitted. So we go to the answer section and just summarize that working. If we come here to the answer section, we are now saying revenue. Revenue, then in brackets, we just show the working. Remember, the total figure that we are given there is 967,000. And then we subtracted the debtors allowance figure that we are given is 23,000. And we add now the, remember the credit sales that were omitted, 15,300. So that's what we have. And then the figure that we are going to get there is 959,300. So, and remember, after that, we move to the cost of sales. Remember, we are going to subtract this figure to get our gross profit. So for cost of sales, again, we go to the list of balances to check the balance that the figure that we are given in terms of this cost of sales. If you come here now on this list of balances, we are going to go up to check the figure what we have in terms of cost of sales. We are here. Cost of sales, we are seeing that is here is 425,500. 425,500. But remember, there are those credit sales that were omitted. It means there was no entry that was done in terms of those in terms of those credit sales. The double entry was not even effected. So what was double entry which was supposed to be there? We were supposed to credit. We were supposed to credit sales, but then these are sales that have taken place, which means the goods are going out of the business. Remember, the goods are going out of the business. So it means the closing inventory is supposed to be adjusted again, because these are figures that went out of the business, so they reduce the closing figure balance. And when they reduce the closing figure balance, it's going to affect our cost of sales. Remember, when you're calculating cost of sales, this is our cost of sales. Cost of sales. We have our opening inventory is on the credit side, and then we've got our closing inventory on the debit side. Remember, and also the issue of purchases will come on the credit, and then if there are returns, come on the debit. Carriages come on the credit, and then custom duties also come on the credit. But basically, you are interested in the effect of this inventory. When these sales took place, these goods were taken from the figure that we have for closing inventory. So it means when we adjusted cost of sales with omission of this credit sales, this figure that was the closing inventory figure was a bigger figure. But now we want to remove the goods that were sold from the figure of closing inventory. So it means this figure is going to be reduced, and when it's reduced, we know that the closing inventory reduces the cost of sales. When it increases, when the closing inventory increases, the cost of sales figure will go down. So there's a negative relationship that is there. So here it means now we are now reducing it. So when we reduce it, the opposite also happens. The cost of sales, it increases. So here we are reducing it with these goods that were sold that we want to record now. But this figure that we are given here, it has a markup inside. This is the selling price. So to reduce, when we are reducing it in the closing inventory figure, we reduce it at cost price. Remember, we say cost price plus markup equals to selling price. So that's the issue that we have there. So we need to make a proportion so that we know the cost price of these goods of 15,300. So let's just do that. So if you go at the beginning of the question, let's go at the beginning of the question there. We are given the percentage of markup that is there. So if you go there, you would see that the percentage of markup is here, which is 70%. So it means the goods were when the goods are at cost price, it will be 100%. So 100% represent the cost price. Then we add the markup. In this case, the markup is 70%. Then we get the selling price. So the selling price will be 170 in 170 there. It will be 170 here. The selling price will represent 170 there. 170. So that's what we have there. If you say 100% plus 70, get 100%, 170%. So the figure that you are given, 15,300, is 170%. So the figure that we want to calculate is the one for cost price, so that we reduce it, so that we add it, to the cost of sales. So we just make a proportion. We just make a proportion there, and say. We just make a proportion there and say we have got 15,300 that is there. So we are just going to say this 15,300, it's 170%. It's equals to 15,300. The figure that we want is 100%. So obviously we are going to get a lesser figure here. So if we have got such a case, we just make a proportion there. Remember, you're going to make a fraction there. We say we want a smaller figure there, so we are putting 100 on top. What we don't have, we put it as a numerator, and what we have, we put it as a denominator. Then we calculate with the given amount, which is 15,300. Then when you calculate that one, we are supposed to get 9,000. So this is the figure that is going to increase the cost of sales. So for the cost of sales, we are going to add with 9,000. So I will go to our answer section and just do that. Remember the cost of sales figure, we can just reconfirm it there in the list of balances. We have cost of sales given the is 425,500. So we are going to add 9,000. So we go to the answer section there, and we make the adjustment. So on cost of sales, we are saying in brackets, remember we have got 425,500. Then we add the 9,000. So if you make that calculation, you're going to get 434,500. So remember, this figure is it's cost of sales we are subtracting to get our gross profit. So here, subtract the figure that we are going to get here now becomes our gross profit for the year. Right. So let's try to subtract there. So if you subtract those two figures, you are going to get 524,800. Right. Having done this, now we go to the section of other operating income. So here we are saying other operating income. So these figures, we get them again in the list of balances. We get them again in the list of balances. We go there to check other operating income that we have there. We can start from the top there where it's beginning there to check if we have got any income that is there. So you go down checking any income that is there. Remember, income is when we are receiving money. So we check, we go down. Right, we've got bad debts recovered. This one is income. What does bad debts recovered mean? It means these are data that we had written off. These were credit losses. We're saying we are no longer going to receive this money. Then we wrote those figures off, saying we are not going to receive any money. Then we charge it as an expense in the statement of comprehensive income or income statement, other less expenses as bad debts or credit losses. But then these people came back and paid the amount owing. And when they do that, it becomes a bad debt recovered, and we regard it as income. So it was 2,504. 2,504. But before we enter that figure, remember when you're entering all incomes and expenses, you first check if there's any adjustment in terms of that income or expense. So before you enter this 2,504, you are supposed to go through the additional information to check if there's anything that is affecting bad debt recovery. So here we are seeing there's nothing. We go to the next page. We can read this one. A data given is solvent, received 500 is dividend of 40 cents in the rand. The rest must be written off as irrecoverable. This one is not recovered. We go to the next, but if you go to 5, receive 1,435 from your previous data, T thanked, and then the account was written off. So this one is a recovery. So it's a bad debt recovery. So we are going to add this figure, 1,435, to the figure that we have in the list of balances. 1,435. We are going to add it to this figure. 2,504 plus 1,435. So we go there and put this figure of bad debts recovered. Right. If you come here, we are saying bad debts recovered. Then we are supposed to just summarize the working that we have there. Remember, we are saying 2,504. Then we add 1,435. So if you add the two, you get the total for bad debts recovered. That is 3,939. 3,939. So that's what we have in terms of bad debts recovered. right? We go down to check again if you have got any other income. It means now we are going down. We are on trade debt recovered. We go down again to check if you have got any income that is there. Let's check. We go down. Go down there to check if you have got anything in terms of income. Right, we have got interest on fixed deposits. This is also a receipt that we have, but this one we are going to adjust it. We are going to adjust it. We are not going to adjust it under other income. We are going to adjust it after operating profit. This one we adjust it after operating profit. So we leave it and check other income that we have. We've got discount received. Discount received 7,218. And also you check if you've got any additional information, anything that is affecting discount received. There you see you don't have. Go to the next page. You check again. You're starting from 3 to check if you've got anything that is affecting discount received. Go up to the end. You see we are not seeing anything that is affecting discount received. So in that case, you just take the figure that we have in the list of balances. So the figure that we have for discount received is here, 7,218. So that's the figure that we are going to put there. 7,218. So here now we are saying discount received. We have 7,280. So that's what we have there in terms of discount received. And then we check again if you have got any other income again. So just above discount received, we left something there. There's rent income there. There's rent income there. So we've got rent income, and we've got a figure that we are given there for rent income. Rent income is 56,800. You are seeing it. So before we enter rent income again, we check on additional information whether we've got anything about rent income. We are seeing on this page we do not have anything. So we go to the next page. We go down to see if we've got anything that is affecting rent income. We go down. We are not seeing anything there. Right. We go down. This is interest on fixed deposit, insurance, telephone. We go down. Advertisement. Then if we go down again, we see that there's rent and rates there, calculated at 5%. Rates and taxes at 5%. Then we go down. Now we've got depreciation. Right. If you go to 13 now, we see there is issue of rent. Rent is for 13 months. The rent was increased with 600 per month on 1 August 2021. So let's just take the figure that we are given there. In the list of balances for rent income is this one, 56,800. So we take it there. We've got 56,800. So 56,800. So what does this figure mean? It means inside this figure, we have got rent for 13 months. But we know that our financial period should be 12 months. So we have got excess rent that has been that is inside 56,800. We need to remove the 1 month extra. Remember, we are applying the matching concept or the accruals concept that we should record what belongs to this year, and what belongs to next year, we record next year. So if you've got something that was paid for next year, this year, we try to find out the amount of that belongs to next year and remove it for this period. We just charge what belongs, or put what belongs to this year. So what we are going to do is we have got 13 months that are inside here. So we need to know the monthly rent, so that we can be able to remove the 1 month that is there. But if you go on, the sentence, sorry, the statement is saying the rent was increased with 600 per month on 1 August, 2021 year, and the rent was increased by 600. So it means from, remember, our year is ending on 28th February. That's where, that is 2020, 2020, sorry, every year end is on 28th February. So for this period that we are preparing, the year started on 1 March 2021. So we need to know how many months were there before it increased, the rent increased to 600. So we are seeing that is from March, the whole of March. Then we have got April, May, June, July. That's when the rent was not yet increased. And we have got 1, 2, 3, 4, 5 months there. 5 months. 1, 2, 3, 4, 5 months. So we've got 5 months before the rent was increased. And then we need also to find out when it was increased now, how many months are there. So we are now counting from August, the whole of August, September, October, November, December, January, February, that's where it's ending. And then for March also, the rent is also inside 56,800. So we have got also March is the extra month that we want to remove. So how many months are there? 1, 2, 3, 4, 5, 6, 7, 8 months. So we've got 8 months after the rent increase. So we can just formulate an equation there that will lead us to find the amount of rent for the extra month. So what are you going to do? We are going. Let's just assume that the rent per month is going to be is represented by X. So it's to say 5X, because we don't know the amount of rent. So we say X is the amount before it increased, and it was for 5 months. 5 times X, we get 5X. Then we add, when it was now increased, we have 8 months. So we have got 8 months times X. It was increased by 600 plus 600. And then the total that we are supposed to get is this figure that is representing all the rent that was received for the period, 56,800. And then we just solve this equation. We solve the equation there. We say if you remove the brackets there, it's supposed to come to 5X plus 8X plus 600 equal to 56,800. Then if you add these two, obviously you are going to get 13X. Then this 600, put it in the side, it's going to subtract 56,800 there. So we say 56,800. Then you subtract 600. Let's try to calculate it there. It becomes 56,200. Then you divide by 13 both sides to get the figure for X. So if you divide by 2 both sides, there we are saying 56,800. You divide it by 13. Then you are supposed to get let's try to find out there. 56. So it's 56,200 there. Then we divide by 13. There, let's try to calculate that one. So there's a mistake there. Because here we say 8 times X, you get 8X. Then say 8 times 600, you get 4,800 there. So we are just supposed to correct here. We get 4,800 here. Then this 4,800 is going to subtract this side now. So it means the figure that we have here also becomes wrong. So you're supposed to remove this one. This figure here. So we say 56,800 minus 56,800. Then we subtract 4,800. Then we get 52,000. Then we get 52,000. Right. We get 52,000 here. When you say 13 into 52,000, there you are supposed to get, let's try to see there. Let's divide that one. 52,000 divided by 13, you get 4,000. So here you've got your x equal to 4,000. So this is the rent before it was increased, and then it was increased by 600. Remember, the month that you want to remove is March 2022. So March 2022, the rent had already increased. So this 4,000, we add now the 600 increase. This is representing before the increase. So add the 600 to get 4,600. So this is the amount that you are supposed to remove from 56,800 to get the rent for the period of 12 months. So we go there and summarize that. So here we have got rent income. So on rent income, we are saying 56,800. Then we subtract the 4,600 that we for the extra month. There you are supposed to get 52,200. So this represents the income that we have there. I think we have exhausted all the income that we have in the question. You can find the total. Here we add, right? So we add this one plus this one plus this one. There the total for other operating income. We are supposed to get 63,357. Then we are supposed to add this figure to this figure to get this figure, which is gross operating income here. So if you add this one plus this one, you get this figure that you get here is 588,000. 588,157. Right, so that's what we have done under gross operating income. That's where now we are going to have our operating expenses. Right, so for operating expenses, we are just going to go through the balances once again and try to pick the expenses that we have in the question. Right, so we start from the top of the list of balances to go down and check all the expenses that we have in the question. So if you come here, you start from here, you're looking for expenses, go down. You're looking for expenses, right? We've got provision for bad debts. This is the first expense that we are picking. So provision for bad debts, remember, if it's an increase, it represents an expense, but if it's a decrease, it represents an income. We're supposed to put it under other operating income. So let's try to see in terms of our provision for bad debts. So we are going to calculate it and then we compare with the figure that we are given here. If there is any, this is representing a provision for bad debts for the previous period. Then we calculate for this period and see if there's an increase or a decrease. So we go down to check the instruction in terms of calculation. Okay, let's try to see what are they saying about that provision. Provision. Right, if you go to item 4, let's go to item 4. It's saying the provision for bad debts must be adjusted to 4%. So our rate is 4% of the trade data that we have in the question, or the data control figure that we have in the question. So we go back to check the figure for data control that we have in the question. Right, we have the figure for debtors control is this one, 58,800, this one. But this figure also, we need to see if there are any adjustments that are there. Any adjustments that are there that needs to be done before we calculate the provision for this period. So remember, we have got those credit sales that were omitted. These were supposed to increase the debtors, this one. So it's going to increase the figures for debtors control there. We're going to add 15,300 there. And also we check if there's any adjustment again that needs to be done. We go there. If you come here, there's an adjustment that is the year. A debtor given is insolvent, received 500 as a dividend of 50 cents in the rand. The rest must be written off as irrecoverable. No entry has been made in the books. So remember, the amount that was paid, this 500 was the one that was received. Was the amount that was received. It represents a decrease in the figure for debtors control. So we are going to subtract that figure for 500 because it was paid. Remember, debtors represent the amount that customers owe us. So when they pay, that figure will go down, will be reduced. So it's going to be reduced. And then the extra amount, the balance again is being said that it was written off as irrecoverable. And when we write off, we are reducing also the amount. We are writing off saying this debtor is not going to pay. So we are writing off. So in other words, we are removing the balance that is there in our books. So it's also going to be reduced. So it means the whole amount is going to reduce the figure for debtors. So how can we find that figure here? We can just use the proportion that we are given here. This is representing 40 cents, the 500 that you are given. And we want the whole amount, which is 100. So what are we going to do? We are going to say 100 cents is the one that we need. Here we are given 40 cents. 40 cents is equals to 500 rands. But we want 100. The whole amount, the amount that we want to reduce the figure for creditors control. Sorry, for debtors control. So here, obviously, we want a bigger figure here. So we are going to put this 100 as a numerator. What we don't have becomes our numerator, and what we have becomes our denominator, and we multiply over the given amount, which is 500. See now. So we see 100 over 40 times 500. Let's try to calculate that one. 100 divided by 40. Then we multiply by 500. You get 1,250. So here is you get 1,250. So this is the amount that is going to reduce also the debtors control figure. So it means the debtors control figure is going to be increased by that 15,200 that was omitted. It's going to be increased by this figure and then reduced by that one, 1,250. So in the debtors allowance figure, we can recheck the amount there in the question. We put a debtors allowance figure that we have here, 23,000. So we are going to say 23,000. We can just calculate it here. 23,000. We are going to say 23,000 is the figure for debtors control. We add the 15,300 that was omitted of credit sales, and then we subtract the one that is being removed, reduced. That is reducing the amount of debtors control, which is 1,250. So if you calculate that one, let's try to see what we get there. We say 23,000. We add 15,300, and then we subtract 1,250. We're supposed to get 37,050. So here we get 37,050. So this is the net figure that we have for our debtors control. And then we use that percentage. Remember the rate that we said is going to calculate the provision for bad debts is 4%. So we are now saying 4% of that one. We say 0.04 times 37 and 50. Right, let's try to calculate that one and see what we get. 37 and 50 times 4%. We get 1,482. 1,482 here. Then we compare it with the provision for the previous period. We compare it with the provision for the previous period. Then we go to the figures that we are given there to see what we have for provision for the previous period. Try to look for that figure in the list of balances. Okay, so the figure for debtors control that we have is here. Let's recheck that figure. It might be a mistake there. 58,800 is the figure that we have there. So what it means here, the figure that we are putting here is not the correct figure. We can just try to remove this one. It's 58,800, and also is going to affect this one and this one. Here, so we are saying 58,000. So the figure that we have is 58,800. The figure for debtors 58,800, and then we add 15,300 minus 1,250. Then we get this figure. Then we are now saying 58,800. Then we add 15,300. We subtract 1,250. We get 72,850. 72,850. 850. And then this is the figure that now we are calculating it here, 72,850. And then we multiply it by 0.04. Then we get 2,900 and 2,900. Let's try to see 2,914. 2,914. So here now we are getting 2,914. And we are seeing the provision that we have for the previous period. The provision that we are having for the previous period. Let's try to check it. Provision for the previous period. We are having it here, 2,850. So we are seeing it's a movement from 2,850 for the previous year. For this year, we found 2,914. So we are going to find the difference between the two. It's an increase. You are seeing it's an increase, and when it's an increase, it's an expense. So we are to find the difference. Now we are saying 2,914 minus 2,850. Then we try to see what we get there. We get 64. So 64 is our answer there. So here you get 64. So this is the figure that we are going to put there in the answer section as a provision for bad debts. So if you come here, we are now saying provision. Provision for bad debts. And I will just summarize maybe the last working that we had there. We said 2,900 and what? 2,900, and let's recheck the figure that we have there. It's 2,914. 2,914. So yes, 2,914. Then we subtracted 2,850. Then we got 64 as our provision for bad debts as an increase. So it becomes an expense. So we go again on the list of balances. We recheck again any expense that we have in the question. We are on provision for bad debts. It's here. We go down, check another expense. We have salaries and wages, 275,559. We check again if you have got any adjustment in terms of salaries and wages in the question. We can start here beneath the list of balances. We can start beneath the list of balances. If we go down, or if you check here, you see that there's no adjustment in terms of salaries and wages. We go to the next page to check if you have got any adjustments. We're starting from 3 there. We go down, salaries and wages. We are not seeing anything. We go down. We are seeing there's nothing that we are seeing in terms of salaries and wages. So in that case, if we have such a scenario, it means we are going to take the figure that we are given in the list of balances, and we put it there as our figure for salaries and wages. As it is, we are having 275,559. So that's the figure that we are going to put for salaries and wages. We come here. We are going to say salaries and wages. Salaries and wages. And the figure that we are given there is 275,559. Right. I will go back again to check if we have got anything again that is pertaining the expenses. Right, we are here. We are on salaries and wages. We now have rates and taxes, 21,000. So we also go to additional information to check if we have got anything about rent and taxes. We are not seeing anything there. Go to the next page again. We start from we have this one, 11. Rates and taxes are calculated at 5% on the value of landed buildings. So what does it mean? It means 5% of the value of land and buildings represents the rates and taxes for that period. Then the one that was paid, we compare if there was a prepayment or there was an accrual, whether we paid more or less. But what is supposed to be charged for that period is 5% of the value of land and buildings. So we go to check the value of land and buildings in the list of balances. So if you come here, land and buildings were 360,000, and the rate is 5%. So we say 5% is 0.05 times 360,000. So we calculate there what we get. Let's try to calculate 360,000. Then we multiply by 0.05. We get 18,000. So this is the amount of rates and taxes that was supposed to be paid, is 18,000. This is for this period. Let's check now the amount that was paid for rates and taxes. We have this amount. Let's check. It's down. Let's check just below there. This one is the amount that was paid, 21,000, which means we paid more. We got 18,000 for the period, but what was paid is more than. So there was a prepayment. So the amount of prepayment now, we are saying 21,000 minus 18,000, which was supposed to be paid. To get the amount of prepayment there, we get 3,000 there. So this one is supposed to be subtracted 21,000 so that it comes back to the correct amount, which is 18,000. So we just summarize that one, 21,000 minus 3,000 on the section of the answer section that we have there. So we have it's supposed to be rates and taxes. We are saying 21,000 minus 3,000. Then we put the correct amount, which is 18. thousand. Right, we go back again to check what we have after that one. Right, we were on written taxes. Now we are on bad debts, 8,160. This is an expense again. But we check again, we have something that is affecting bad debts. I still remember. Let's go to the next page. We have something that is there that is affecting bad debts. Remember, we have this one. We are saying a data given is insolvent, received 500 rand is dividend of people of 50 of 40 cents in the rand. The rest must be written off as irrecoverable, no entry has been made in the box. So what it means is we need to calculate the one that was written off and it represents bad debt. That is going to decrease the figure that we have in the list of balances. So we are just going to make a proportion again here. Remember, this is the total amount that we got, 1,250. And out of the 1,250, the 500 was paid. So it means the remainder is going to be written off. Or you can just use the proportion. So what I'm saying is you can say 1,250 minus 500 that was received. Then we get the one that was written off as irrecoverable, that becomes our bad debt. Or you can use the proportion again there by saying the other alternative that you can use is, you can say 40 is equals to 500. And then the remainder is the one that was 10 off, which is 100 minus 40. And we get 60. So 60 is the one that we are looking for. So obviously we want a bigger figure there. So what we don't have numerator, what we have denominator, then we calculate by the given amount. Then you get when you do that, let's try to calculate that one. Let's try to calculate that one. You get 750. So is this the figure that is going to increase the bad debt figure that we are given in the list of balances? We have 8,160, then we are supposed to add 750. So if you come here, you're going to say bad debts. We have bad debts, and we say 8,160. Then we add our 750. And then the amount that you are supposed to get is there 8,910. So that's what we have in terms of bad debts. We go back again to check another expense that we have there. Right, after bad debts, we've got water and electricity, 89,800. Water and electricity, 89,800. We check again. Do we have anything that is affecting water and electricity? Here we don't have. Go to the next page. We go down. We are seeing nothing there. So it means we've got nothing that is affecting water and electricity. We take the figure that we are given in the list of balances for water and electricity. Let's check that figure. Is this one 89,800? So we are going to put that one. So here we have got water and electricity. And electricity, and the figure that we have water and electricity, remember it's 89,800. Then we go back again to check what we have after water and electricity. Right, we have got bad debts recovered. We adjusted that one under income. Then we've got telephone. We have the issue of telephone. The figure that we are given there is 28,250. Then we check if you've got anything that is affecting telephone. We have anything that is affecting telephone. Right, we check there. On this page, we don't have anything. Go to the next page. We see on item 9, telephone for February 22 is not yet paid 1,561. This is an accrual not yet paid. So it means we need to add it to the figure that we are given in the list of balances. So we've got 1,561, and the figure that we are given in the list of balances of telephone it's 28,250. So we add the two. We add the two there. So we are saying telephone so in brackets we are saying 20,250. Then we add the one that is not yet paid, which is 1,561. And then the figure that you are supposed to get is there, 29,811. Right. I'll go back again to check the next expense that we have. Right. I'll go back to check the next expense. Telephone is the last one. Then we go to stationery. Stationery, we've got 18,674. Stationery is here. It's here. 18,674. So this indicates the stationery that was bought, and then the expense part of the stationery is going to be what remain. What was used during the period. So if you come here, we are seeing we've got a stationery that's there is our closing or so at the end. So to get the stationery, the amount of the stationery that was used, we say what was bought minus what is remaining, and we get what was used, and what was used to represent the expense. So we are going to say, let's take note of the figure that we have there. For stationery that was paid for, that was bought, we have this one, 18,674. 18,674. Then we subtract the one that is remaining at the end, 2,546. 2,546. So we are saying stationery. So we are subtracting 2,546. And the figure that we are given that represents what was paid for is 18,774. Then we calculate the expense part. So we now saying 18,674. And then you subtract 2,546. Then you get 16,128. 16,128. So that's what we have on stationery. We go to the next. So the next one now that we have, let's check there, just beneath stationery, what we have. We have interest on fixed deposits. 4,000. Remember this one we said we are going to adjust it after operating profit there. Then we got interest on members' accounts. We also add to this one and adjust it under operating profit. Then we got insurance, 27,305. Then we check again in adjustment in terms of insurance. Insurance, we have there insurance of 300 per month for 4 months is paid in advance. So we have 300 times 4, get the one that was paid in advance, we get 1,200. So we are going to subtract this one. Remember, any expense that is paid in advance, we subtract the amount. So we are going there and say the figure that we are given for insurance, 27,305 minus 1,200. So we go there and say insurance. Insurance we are saying 27,000. Then we subtract the one that was paid in advance, which is 1,200. Then when you subtract that one, you're supposed to get 26,105. Right. That's what we have there. And then we go back again to check what we have after insurance. Right. After insurance, we've got advertising. And the amount that we have is 9,000 for advertising. We check again in adjustment in terms of advertising. We've got here advertisements includes a contract of 3,600, which is with the local newspaper on 1 October 2021, make provision for the amount paid in advance. Like this advertisement stretches from 1 October 2021. It is for 1 year, so it's from 1 October 2021 up to end of September, which is maybe 30 September 2022. And our year is ending in between the year, that is February 2022. So it means we've got some extra months that are there that are not within the period of our financial period. So we calculate how many months are there after February 2022. So after February, we've got March, April, May, June, July, August, September. So we have got 1, 2, 3, 4, 5, 6, 7 months. 7 months that should be removed from the figure that we have for advertisement there. So to calculate that amount, we are now saying 7 over 12. Let's try to create some space there. Now we are now saying 7 over 12. Then we multiply by the figure that we are given is this one, the whole amount. But you just want to remove the ones that are not in the financial period that we are preparing. So we say that one. Let's calculate that one. We say 7 over 12. Then we multiply by 3,600. Then we are going to get 2,100. So this is the figure that we are going to subtract. Here we get 2,100. This is the figure that we are going to subtract from the total figure for advertisement that we are given there. So we go back there and say the figure for advertising that we are given is 9,000. Then subtract 2,100. So we go there to the answer section again, and we are going to say advertisement. They're saying 9,000 minus 2,100. 2,100, and we get 6,900. Go back again to check what we have next after advertisement. Interest on mortgage loan. This one it's an interest on loan. We adjust it again after operating profit. Rent income, we've adjusted it. Discount received, adjusted it. Now we've got discount allowed, 1,800. Discount allowed, 1,800. So this one again does not have any adjustment. So we're just going to put that one, discount allowed, 1,800. So here we've got discount allowed, 1,800. And then lastly, we have the issue of depreciation. And we go to the question to find out what do we have in terms of depreciation. We've got information that is explaining about that depreciation. We go down. Right, we have got here where we now item 12, make provision for depreciation as follows: equipment at 15% of costs, and then in bracket there's a new equipment bought on 1 February 2022, valued at 90,000, and it was properly recorded. Then last point, make provision for depreciation on the vehicle at 20% on the carrying value. So let's start with the depreciation on equipment. Let's start by calculating depreciation on equipment. So maybe we can just try to create some space there. So depreciation on equipment. So what is important is for you to take note of the rate that we are using for equipment. Equipment is of course so a straight line method. But what is important also, let's take note of the one that was bought. It was bought on 1 February 2022. That's the month that is ending the year. So it means this equipment that was bought on 1 February 2022 stayed only 1 month. It stayed only 1 month. It stayed only 1 month. And what does it mean? We can start by calculating depreciation for that one. And it's 0.15 on cost. So we are saying 0.15 times 90,000. But this 0.15 times 90,000 will give us a depreciation for the whole year for this, but for this non-current asset, but it stayed only for 1 month. So we multiply the answer that we are going to get by 1/12 to get the 1 month, 1 month over 12 months to get the proportion of 1 month. So when you calculate that, one, you are supposed to get 1,145. So this represents depreciation for this non-current asset that stayed 1 month. And then we want to see equipment that stayed for the 12 months. We go to the list of balances. Remember, the figure that we have in the list of balances includes the 90,000 because here they are saying it was properly recorded. So it's inside that figure. So you need to remove the 90,000 to remain with the balance of the value of equipment that stayed for the whole year. So you go to the list of balances and find the figure that we are given for equipment there. So you'd see that the figure that we are given for equipment is here 250,000. So you're going to say 250,000 minus 90,000. 250,000 minus 90,000. So here you can calculate it here. We say 250,000 minus the 90,000. And you get, let's try to see 250 minus 90. Then you get 160,000. So this is the cost of those that stayed for the way. And then we multiply by the percentage. Remember, the percentage is, we can reconfirm the percentage there. The percentage is 15%. We are seeing it, so we multiply by 15%. 0.15. And then we find for the way there, which is, let's try to calculate again that one. We say 160 times 0.15. You get 24,000. You get 24,000. So this is what we have. This is the depreciation that we have for equipment. We have one for 24,000 and one for 1,145. So we add the one for 1,145 for that one that stayed only 1 month. And this is equipment. So we also need to find depreciation for the vehicles, and we add to that one. In the vehicles, let's listen to the instruction. The vehicles, they are saying make provision for depreciation on the vehicle, 20% on the carrying value. So we are just going to there and calculate the carrying value, and then we say 20% of that carrying value. Vehicles, we have a cost 385,000, accumulated depreciation 101,500. So what are we saying there? Let's try to see. So what we are saying there is we are saying the cost for vehicles is 385. To find the carrying value, we say 385. Then we subtract the accumulated depreciation, which is 101,500. We subtract the accumulated depreciation, which is 101,500. So for the carrying value, you are getting 283,500. Then you multiply it by 0.2. Remember, the rate is 20%, and then you get 56,700. So this is our depreciation for vehicles. Then to get the total depreciation now, we are now adding to get the total depreciation. We are now adding all the depreciation that we have. Remember, we got 24,000 plus 1,145 for equipment. Then we add again 56,700. So in other words, here we are adding again 56,700 to get the total depreciation. So we can just go there and summarize that one for depreciation for the year. So if you come here, we are saying depreciation in brackets, we have got 56,700. Then we add 24,000. Then we add again 1,145. Then we get our total depreciation, which is 81,845. So this becomes and then we also have we still have another expense that we need to adjust there for trading stock deficit. We've got a trading stock deficit that we have in question. We can enter that one again. Trading stock. Right, trading stock deficit, we are saying the value of the stock that is in the books is compared to the physical stock count that is taken place. So if the physical stock count reflects a balance that is less than what is being reflected in the books, it represents a deficit. So let's try to check what we have in the books first. In the books, we have got trading inventory. It's here, 58,690, 58,690. But remember, we've got those ones that were sold, but were not recorded. These ones, we've got these ones are here. These ones were the goods that were sold, but were not recorded. It means that they were not removed from our closing stock. That is reflected in the books. So we need to remove that 9,000 because we reduced this one when we said 100 over 170, then we multiplied by 15,300. Then we got 9,000. So this 9,000 we need to subtract it from the figure that we are given in the list of balances to get the book value of the trading inventory. So here we are given the figure for trading inventory is let's check the figure that we have, that one. Trading inventory is this one, 58,690. Then you subtract the 9,000. So let's just try to calculate that one, 58,690. Then we subtract the 9,000. Then you get 49,690. 49,690. 49,690. So what we are saying here, we are saying the figure for inventory is 58,690. And then we subtract the 9,000 that was sold but not recorded, the goods. And then we got 49,690. So this is now representing the book value. So basically this is the book value. And then we compare it with the physical stock count figure is the one that is given in the additional information. 49,590. 49,590. We see this one is lesser than that we have there, so it represents a deficit there. So we subtract that one, 45,590, from 46,690. 690. So here we are saying we are subtracting 49,590. Obviously, we are going to get 100. So this is what we are going to summarize in the working, find our deficit. $49,690 minus 45. Sorry, minus 49 here. Here is 49. 690. 49,590. So here we have got 49,590. Then we get 100 here, representing our deficit. So this last expense that we have. So if we add all expenses, we are going to get 555,022. And then you now subtract the operating expenses from our operating income. Then you get 33,135. 33,135, and it's going to come down there. 33,135. So it's going to come here as our operating. It's going to come there as an operating profit here. We get 33,135. Then after that, that's when now you are now going to add interest income. And this interest income, we have got it in the question. We go back to the question there. Those are those ones that we skipped at that time. We can go back and recheck those figures. We've got interest on fixed deposits. This one, 4,000, and then we also have 1,400. 4,000, 1,400, and also we can check if we've got anything again to do that in additional information. Anything to do with that in additional information of interest on fixed deposits. Right, they are saying here on 7, make provision for an outstanding interest on the fixed deposit. The fixed deposit was taken out on 1 May 2021 at 8%. So it was taken out on 1 May 2021 at 8%. So it means we can calculate that one 8% of the fixed deposit that we are given there. So we are going to say 8% of the amount of fixed deposit that we have. Then we get the fixed deposit for the per annum, which is for the whole year. But we are seeing that this fixed deposit was taken out on 1 May. So it stayed in the business for May, June, July, August, September, October, November, December, January, February. So it is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So it was in the business for 10 months. So we need to calculate now. If you find the interest on fixed deposit for per annum, which is for 12 months, then we calculate for 10 months to see the one that is supposed to be recorded for that period. So that's what we are going to do. And if we have got a more figure than what we have there, then we can adjust to see if there's any prepayment that was there or an accrual that was there. So basically 8% is the figure that we have, and then we apportion it to 10 months. So we come here, our fixed deposit is 75,000. So we say 0.08 times 75,000. And when you do that, you are going to get 6,000. So this is per annum. And then for 10 months now, remember the fixed deposit was there for 10 months. So we are going to say 10 over 12 times 6,000. then you are going to get 5,000. But what we are seeing now there is that the amount of fixed deposit that was received, of interest on fixed deposit that was received there, is only 4,000 instead of 5,000. So there is an accrual that is there of 1,000. This is 4,000 instead of 5. So you need to add 1,000 here so that it gets to 5,000, which was supposed to be received. So that one we are going to add 1,000. We go to the answer section. Go to the answer section, and we are going to say interest income. Interest income. Remember, we said we are adding 1,000. 4,000 that we have there, in 1,000. So we are saying 4,000, 1,000 plus the other one that we are given there on a current account, which is 1,400. Remember, also have another one that is there. We can recheck that one. If you come here, we've got this one that is there. This one, interest on members' accounts, 1,400. So we are adding this one plus the 1,000 that was still outstanding. So go back there. So here, if you add 3 there, you get 6,400. Then there, try to see what you get there. Right. If you add there, then we add our interest income to the operating profit figure. There we are saying 333,135, 33,135. Then we add 6,400. Then we get 39,535. 39,535. Then obviously we have got an interest expense. Interest expense that is there. Go back to the question and try to see what we have in terms of interest expense. Right. On interest expense, try to see on additional information if you've got anything about interest. Only for fixed deposits, then we check there. Then we go back there and try to see what we have in the question. Interest on mortgage loan, we are given 17,000. We are given interest on mortgage loan is 17,000. And we check if we have got any adjustments in terms of that. We go back to the details of the mortgage loan that we have in the question. We have a mortgage loan. There it's 10% of 140,000. That's our interest. 10% of 140,000. 10% of 140,000. So that's the figure that we are given there in terms of description that we have for mortgage loan. So the interest that was supposed to be paid for that period is 10%, which is 0.10. Then you multiply by 140,000. Then you get 14,000. So this is the interest that was supposed to be paid. But if you go down there, you'd see that the interest that was paid is more than 14,000 there. It's 17,000. This is the interest that was paid, 70,000, which is more than So we say 17 minus 14, you get 3,000. So we the prepayment of 3,000. So you're going to remove the 3,000, say 17 minus 3, so that will go back to 14,000. So we go there and summarize that. So we say here, if you come here now, we are saying interest expense. We say 17,000 minus 3,000. Then we get our 14,000. Subtract it from there. Get our now the figure that you are going to get now becomes the net profit for the year. Becomes the net profit. Yeah, so we are saying 39,535 minus 14,000. Get 25,535. So this becomes our net profit for the year. So this is the final figure that we have according to our question. We've completed our income statement. This is what we have, guys. Stay tuned for more videos. Those who have subscribed, please subscribe and share. I will meet again in the next videos. With that, I'm signing out.